You've been lied to if you've been told that you have to buy property via a limited company. Well, saying lying is probably a little bit strong, but probably misled, because in this video, I'm going to share with you how I've bought property in my personal name, the pros and cons of buying it in your personal name, and I'm going to take you through a process of where you can decide whether or not it's worth buying a property in a personal name or in a limited company, not a little company. But a little disclaimer, that's where I was going with a little disclaimer before we get into that. I'm not a tax advisor, I'm not an accountant. Make sure you go and get your own accountancy advice from professionals. But what I will do, if you hang around to the end of this video, I'll share with you a document how you can qualify and disqualify, a process you go through to get the right accountant in your business. So I'm Harvey, I'm a remote property investor. Means I live in the south but invest in the northeast. And one of the most important things you can do in your business is get the right team around you. The thing with accountants is that you get a generalist accountant and you get specialist accountants. If you was to read the whole tax code, it will take you apparently 130 years to read the whole tax code. Bearing in mind the tax code changes yearly. So there's no one accountant that can know every single area of speciality. Think of it like a doctor. When you go to your doctor, you're feeling a little bit ill, you go and see a GP, a general practitioner. Then if there's something wrong with your heart or your head, they'll go to you, okay, go and see a cardiologist or a neurologist relevant who's a specialist. And in this field, doctors know their place, kind of thing. They know if it's a specialization for them or not, and they send you to the right people. In accountancy, the same principle works. You need specialists if you're going to be if you're running certain style businesses, and especially property. But what happens, unlike the doctors, I find accountants do not like to know, what is the word I'm looking for? They don't like to admit when they don't know something. And we don't know what we don't know. And I know it's a pride thing, an ego thing, because they're professionals. They often tell you they know something when they don't know it. And it's just that they don't know what they don't know. So it's really important for you to qualify that person that is correct, to get the correct advice. And as I said, should you be buying a sole trader or limited company? The answer is depends on you. Most accountants today will lead you towards limited company. The reason behind that, or most people will say limited company as well, and the reason behind that is because of Section 24 tax. If you've not heard of the Section 24 tax, this is explained very simplistic. Bearing in mind, I'm not an accountant. These are not exact figures. This is just a principle behind it to give you an idea of it. But let's say you've bought this property and you've got you rent this for, it's a nice old property, let's get a bit more detail on there, but let's say you rent this property for £1,000 a month, and we'll just keep these figures very, very simple. And let's say you've got a mortgage on this property for £500 a month. How the tax works, if you use a low rate taxpayer in your own name, and you bought this property, let's get a different colour over here. So first of all, you buy this property in as a sole trader. So how the tax works, if you're a low rate taxpayer, no matter how it used to work, was not no matter if you're a low rate taxpayer or not, is you would say, okay, if it's an interest only mortgage, that's the thing I was trying to think of. So if this is interest only, what you would do would then deduct this £500 from the £1,000, and you would be left with £500 profit. Then you would be taxed on that profit relevant to if you're higher rate or low rate taxpayer. So there you go. So you'd be taxed relevant to this £500, which would be 2, 4, 6, 8, 10, 20%, £100. Would be taxed at £100. If you was a high rate taxpayer, you would then be taxed at 40%, so you'd get a £200 tax bill. So how this has changed is, if you're a high rate taxpayer, what happens is they no longer allow you to offset the mortgage if you own it in your own name. It's only when it's interest only. So you're going to be taxed now on this amount, on this £1,000 up here. So let's try not to get this too messy. So you're going to be taxed on this £1,000. So if you're a high rate taxpayer, you're going to get 40% taxed on that as well. So instead of paying £200, I didn't put an O on the end there, but instead of paying £200, you're now going to be paying £400 in tax. But bearing in mind, you only get a £500 profit. Then when you deduct all your fees and everything like that, and maintenance and voids, that will then make this profit unviable as an investment vehicle. So what people have suggested is, if you buy it in a limited company, so we do these same equations over here. If you buy this property in a limited company, you get charged 19% tax up to about 250k, I believe it is. But you paid 19%, so most of you would be looking at 19%. There is no bracket where you go above. So it's when you go above around 50k's worth of earnings, it's not exact number, but if you go above 50k's worth of earnings, you get dragged into the section 24. You can go up to 250k's worth of earnings and you still pay 19% in a limited company. So a lot of people are saying do it in a limited company, but what you have to think about if you try and do this in a limited company is, this limited company is a separate entity to you. So let's say your profit is £300 in this limited company. You cannot touch this money because this entity is not you. So for you to get that £300, you have to then pay it across to your sole trader, which will then mean you have to pay income tax on it. The disbenefit of buying a limited company also is the interest rates are higher, the arrangement fees are more money, solicitor costs are more expensive, everything costs you, accountancy fees cost you more money. So everything is more money when you buy in a limited company. So it can really erode into your profit. So if your profit was £300 in a sole trader, that might go down to 30 because of all the extra costs incurred on the buying costs and running costs of a limited company. So it's not clear cut should you buy a sole trade or limited company. The way you want to ask yourself is, do I want to be a high rate taxpayer? So I said at the start of this, I've got some properties in my sole name. So when I had a portfolio, I can't remember exact amount, but I think I had 7 before this tax come in. The old way everybody used to do this is buy as many properties in your sole name until the bank stopped lending to you, then you buy in a limited company. So I bought 17 properties in my sole name. So this then took me above, I don't know if it's exactly 50k, it's about 52k, go and look that up please, but say my 50k bracket for being a high rate taxpayer, these 17 properties took me above that. So what happens is, it doesn't, like, tax is marginable. So basically the first, I don't know exact figures, but the first 12k you earn is tax free. So it's called marginable. So it goes up, and then from 12k up until 50, I think it's 52k, don't quote me on that, but around 50k we'll say, so don't quote me on that, it is then 20% tax. And then everything above 52k, so everything above 52k is 40%. And then when you get above that, it's 45, but we'll just stick with it there. So it's marginable. So you only, if you earned 60k, you're only going to pay 40% on the 8k. So if that makes sense. But what happens with this, if you go above the threshold with property, it drags a whole, it's no longer marginable. It drags a whole portfolio into you paying this here, the 40% on it. And this is combined earnings as well. So if you've got a job elsewhere and you've got properties, it's combined earnings. This is why so many landlords are exiting the market at the moment, because they're getting stung with tax, getting stung with compliance. It's not the same as it used to be. If you understand as buyers in a limited company, that's great, because you know how to structure this correctly. But a lot of old school landlords haven't got the time and effort to reincorporate. But I bought these 17 properties over here in my sole name, and as a result, what I've done initially was, okay, because I was over the 50k, I sold. So I sold to my limited company down here. Let's say this is my limited company. I sold, how many was it? I think it was 3 properties to my limited company. And what I've done, this is my LTD, this might look good. What I've done with them 3 sales of them properties was, every year you get it's going to be gone very soon. At time recording, previous years you got a 12k capital gains tax allowance. So I couldn't just say I'm going to sell this property to this company and not pay any tax. It's a different entity. As I said, this is a completely different entity, my limited company. So me selling a property to my limited company means I pay stamp duty, tax, and all the legal fees. And to top it off, if I bought this property, say, for 20k 20 years ago, and I say I want to sell it to my property for 20k today, the HMRC will say, no, that property is now worth 150k. You're going to be charged capital gain tax on what the market value is, not what you sell it to, which is bonkers to me, but that's just the laws, that's the rules they make up, basically. So what I've done is each year I sold one property to my company and I took my capital gains tax allowance, which this done was brought me underneath this bracket here. So now I was like, okay, sweet, I'm in, like, because it only majorly affects people, high rate taxpayers. Talk to accountants, there is little nuances, you now get a credit, but if you're under 50k or underneath that 52, whatever that bracket is, it should not affect you the same. Speak to an accountant, but I got under that bracket, it didn't affect me the same. So I thought, happy days, I've made this now. It saved me, because if I want to, there is a thing you can do, it's for another video, it's called incorporation. So if I want to incorporate 17 properties, it would have probably cost me like 25, 30k to do that. So I said, instead of paying 25, 30k, I pay stamp duty on 3 properties, which worked out, because they're low value properties in the north. I think I sold them to my companies for around the 80k mark. So it worked out like under 10k instead of like 20, 30k. So I opted for this option because I thought I was saving money. But what I didn't realize was at one point I'm going to want to break this barrier, especially when I want to buy nicer homes, bigger mortgages for myself, nicer things. There's a benefit from a company is you can run a lot of expenses like your cars and stuff like that in the company. But there is a point where you're going to want to draw more money out of this business. And as soon as I do that, it's going to take, I've got 14 properties left in my portfolio. So let's wipe this out now. This is now 14 properties. The minute I want to draw and give myself a bigger salary from my companies, because I've got multiple other companies earning good money, so the minute I want to draw more money out, it's going to sting me here. So these are the other options that you can do. Like if you don't want, I've trained somebody, she just wanted a bit of extra income. She never wanted to grow a portfolio above 50k income. Her husband earns good money. She just wants her own bit of pocket money. So buying in her own name made sense for her. What you can potentially do is, say if you're in a partnership anyway, there's you and her and you're doing this as a relationship partnership, you could potentially utilize somebody else's bracket. Definitely go and get legal advice on this, tax advice. I'm not an accountant. This is an idea I'm putting out there. Make sure it's solidified. So I do want to put that there. But let's say there's you and your girlfriend or husband, whether or not you are a lady or a man watching this, you are both here. So you have both got a 50k or 52k, whatever that is, personal allowance above your head on the tax. So what you could potentially do as a partnership, this is what I'm looking at doing with my partner. She works at the moment, but if she didn't work, what I would potentially do is say, okay, we're earning 50k from this portfolio. We are partners in this business anyway. So what we're going to do is I'm going to give you, and it's called a Form 17, I believe it's called. You can allocate, even if you're a partnership, you can allocate the earnings to one person. So we're going to allocate it to this person here, and we're going to use up your bracket there. So then everything else we earn going forward above 50k, we're going to take from this limited company, and then I will take a salary. So if that's me and that's my wife, I'm going to take a salary. You see my wife's got a bigger smile on her face. Of course, she's much more beautiful than I am. But I'm going to take a salary from that there. And it's not going to affect her tax allowance. It's not going to affect me. So we can still own these properties in our sole name. I can't do that at the moment because my wife earns a good salary herself and it's still going to push it above that bracket. So what I'm looking to do is incorporate it. I'm hanging around with this. I'm going to put it on record. I really wouldn't be surprised if the government reversed this Section 24. It went into 3 other countries and they all reversed it. At the moment, it's one of the biggest pressures they've got. Even the government, within the government, Labour and Conservative, have lobbied the government to try and look at the reforms they've done in the private rented sector, because we've lost around 50% of family homes in the private rented sector, which is forcing the rents up at the moment astronomically. So that's a video for another time. But coming back to this is an option you could do if you use a husband and wife partnership. I probably only do it if it's husband and wife partnership because partnerships don't always work. Where even husband and wife partnerships are notoriously high rate of failure, but a normal partnership with somebody else, you've got to look at the intentions and the long-term view of it. But in a husband and wife partnership, it can work great. If you want to only earn 50k, you might be 2 of you. You've got 100k between you, or 104k, or whatever that figure is. You might say, between us both, if we earn 100k from a portfolio, we don't want to be massive portfolio owners, because the bigger portfolio you own, the bigger business you own, the more pressure and stress that comes with that. So you might say 100k is enough for us. We get it managed by a letting agent. We're going to travel the world. So if that's you, then you might consider doing it in your own name. The only other caveats you've got to consider with that is that you might get inheritance tax benefits if you don't do it for a limited company. Again, it's a different video for a different time. But these are other things you've got to think about. But it's not as clear cut as going straight in saying, I'm going to do this in a limited company. As I said, you'll pay a lot more to it if you're not a high rate taxpayer, and it'll eat into your margins. So go through this, make sure you can figure out who you are, what your end goals are. Your end goal is really important. If you're in a partnership, what you want to gain from this, and then start piecing that together. And then you want to go to an accountant and then tell them what your plan is. And does this work? Tell them if you're planning to do it this way as a partnership. Tell them if you're planning not to get above 50K, does it still work? You've got to go to them with preloaded questions. And as I said, if you hang around to the end, I'll give you them preloaded questions. So if you comment accountant in the comments, I will send you a little ebook that'll show you how to qualify and disqualify an accountant. Make sure you're asking them the right questions and get the right preloaded questions. And there'll be a few resources there and videos, because you want to get a base knowledge on your understanding before you go to them. You don't want to be an expert, but you still need a base knowledge. So we give you some bits you can research and get a base knowledge really, really quickly, so you can go and ask the correct questions. But let's face it, the only way this is going to be of value to you is if you are building a portfolio. And if you're unsure about what portfolio you want to build and what strategies to do, because there's tons out there, you don't want to watch this video, I'm not sure what side it's on, now head over there now to watch which is the best strategy for you to take forward. And listen, if you're still here at this point, massive thank you very much. People like you really help this channel and help my growth and my mission get out there. My mission and my why is to live on my terms. My mission is to help as many people live on their terms, using property as a vehicle to do that. So please help me by hitting that like button, smash the subscribe button if you've not done it already, and hit the bell icon. Share this out to people you think find this valuable. And remember, if you don't evolve your ideas, you're never going to live on your own terms. So evolve your ideas, live on your own terms, and have an amazing day.